Okay, so now change of topic, and I just wanted to talk about the bond market. I've not done any charts or videos on the bond markets for a couple of months because they've not been terribly active, and I've been unclear as to what kind of trend direction we're going to get in terms of the bond market. So I wanted to revisit that with a couple of charts today. And the first chart I brought up is a very long-term chart of the 10-year bond interest rate. This is on TradeStation. The symbol is TNX.X with a dollar sign in front, and this is a monthly chart. And you can see these are interest rates for the 10-year bond 10-year bond contract going back to, I think this is 1962. Here we go. So, and the way you read this chart is the interest rate is 1/10 of the index reading. So we had in about 1981, we had a peak here in interest rates of about 15%, and then we've fallen to a low in interest rates in the last year to, I think the low on the 10-year was about 2% down here. So that's how you read this chart. Now the interesting thing that's you can see from this chart is that there's been two trends over the last 30-40 years. We've had a huge uptrend since the 62, peaking in about 1981, and then since 81 been a huge downtrend down to the current period. And this reflected the inflation background that the economy, the US economy, and most of the developed economies were seeing during those times. So from the 60s to the beginning of the 80s, we had higher inflation, and then from about 81 onwards we had lower inflation. And the reason why the interest rate on the 10-year bond goes up is because investors have to be compensated for that lack of purchasing power. If they're going to be putting their money away into a government bond for 10 years, if there's an expectation of higher inflation during that period, they want to be compensated for that so that they don't have kind of diminishing purchasing powers over that time. And during this long down trend, we had lower and lower inflation going on, and so the yields came down on these treasuries because there was greater purchasing power with less inflation kind of going on compared to historically, at least. So those are kind of the big two trends that have been going on. And then I can actually overlay my sine wave indicator on this to give us an indication of kind of turning points. You can see that the Hilbert sine wave, this is the better sine wave indicator with these support and resistance lines kind of going on. They give you some indication of where you might find support in these inflation interest rates. So we can have kind of bottoms being made here, breaking out into uptrends. Then coming into this downtrend, you can see we've got some kind of formation of resistance levels, support, resistance levels, likely support levels, and so on. And what's important at the moment, or interesting at the moment, is that we're reaching underneath a critical resistance level on the 10-year and the 30-year. Both the pictures looks extremely similar here. Above which, if we break out above this resistance level, we'll be in an uptrend when it comes to yields. So that's an expectation of greater yields being required to interest investors in bonds. And the corollary to that, because the interest rates might be moving up, the prices will be moving down. Now, the reason why the rates might be going up, my personal opinion, there's a whole kind of discussion whether this is inflation driven or not. My personal opinion is that we're not really seeing a great deal of inflation in the economy. We're certainly not seeing it in terms of wage inflation. There's just so much overcapacity and underutilized as physical assets and human assets in the economy that we're not going to see wage rate inflation. There might be some sectors of the economy where we're seeing continued price increases, healthcare, some food items and so on, but in general I don't see inflation as being the real problem here. The reason why these rates, these yields might start to break into an uptrend is because the investors are seeing greater risk from credit worthiness. So with the US economy, the US government debt position, they're seeing that the US government is a less risky bet than it has been in the past, and so that we might actually start to be seeing a breakout into rates increasing and bond prices going down because of the US government being not as safe bet as it used to be historically. we've never had the amount of discussion that we've had recently about the debt levels in the US, particularly on the government side, that we've seen, and we're seeing this position across all developed economies. So we might be seeing a breakout in these yields going forward, and I just want to show you what the my charts are showing on the bond chart. So this is the inverse, if you like. This is the price of the bond, so which is going to be the inverse of the yield on the bond. And on the monthly chart, you can see we broke into an uptrend a couple of years ago. We had this peak that was made up at 120. We've had a pullback, and we've just had a cyclical turn on the monthly Hilbert sine wave here. And as soon as this low is broken on the previous month, that's going to signal an end of trend warning signal on this chart. And if you look in this long-term picture, you can see that we had our bullish excess buying at this point. Coming into these highs, we had less and less buying pressure going on, with a couple of bearish divergence signals here right up at the tops, and we've had less and less buying pressure going on, and we might have a turning point happening. Interestingly, this peak was actually made on fairly, I would see these as amateur bars. The traders that were buying up at these elevated levels were amateurs at that point. So that gives some kind of indication that this is a false top. We had a couple of Rambo patterns, and we might be seeing an end of trend warning signal there and a change of trend going on. If I drop down to the weekly chart, I've got a similar situation. We've just had an end of trend warning signal. I think this was last week. We had this kind of exhaustion buying happening a couple of weeks ago here, and ever since the buying pressure has been weaker and weaker. We had bearish divergence previously, and this was a little bit of a pop in the market, and we've kind of subsequently fallen off. Here's the rise you can see into this 120, 122 kind of level that we had over a couple of years ago. Again, this is kind of amateurs making these new highs, and that ends up being signaling an end of trend warning signal in the market going the other way. And then if we drop down to the daily chart, and I'm looking at a 1440 minute chart here, you can see this was the recent pop that we had in terms of buying volume. We'd have bearish divergence and professional activity at this kind of high rolling over. We had a final push into these highs, some amateur bars here up at these highs, momentum buying up here, exhaustion buying up at this point, and subsequently a couple of bearish divergence points, and we've kind of sunk down. Now we had a couple of large range down days going forward, but on Friday, this is Friday's activity, it was very low volume, kind of, the professionals weren't at work on Friday, but there were the non-farm payroll numbers that came out, and there's a rumor of a potential Fed meeting, I think on Monday, and the expectation might be that there's going to be another kind of surprise increase in the Fed interest rate. So we could be seeing at this critical level here a break below support and moving into a downtrend when it comes to the 10-year note. Now the 30-year picture is very similar to this. I've not pulled out that chart. The signals are a little bit clearer for me on the 10-year chart, so that's why I'm kind of looking at these indications kind of going forward. So just wanted to kind of point that out, that we're at a critical juncture when it comes to the 10 and the 30-year government bonds, that they might be breaking out into a lot higher interest rates, and if this breaks into an uptrend, we're going to start to see large moves in these yields and interest rates over a short period of time. And so that's something that's definitely on my radar screen and I'm just looking at the moment. So hope you're having a good weekend, and I'll be posting a series of videos on Sunday that I hope you'll all enjoy.